It's Brian Preston, the Money Guy.
But I want to talk about some of the, what I call it secret or special rules that people don't know about, how they can actually get access to their employer plans through these special withdrawal provisions.
Now, I feel like before we talk about this, Brian, we ought to put on there the appropriate disclaimer that retirement assets are supposed to be for retirement, right? Like you want your army of dollar bills working for you, so you don't want to take those soldiers out of the battle too soon. You don't want to pull them out. But we all know that life happens, and sometimes there are special circumstances that we may not be 59 and a half yet, or we may not have left employment yet, but we're in a tight spot, and we need to have some access to capital. There are special provisions that are allowed within certain 401k plans.
Yeah, now look, I think not to keep adding disclaimers, I don't love you actually pulling your money out early, especially for some of these special things, but I think it's important to at least know, just in case you get into a pickle of a situation, you know all options so you can plan accordingly. And the first group is hardship withdrawals. And these can be emergency reasons that you had to get access to your account. You know, the big ones that come to mind is medical expenses, permanent disability, prevention of eviction or foreclosure, burial expenses, and then this is one, and look, I don't love this because hopefully you know, with being part of the Money Guy family and the Financial Mutant, we give you a lot of latitude on that house down payment where you only have to put down 3 to 5% on that first home purchase. The government lets you actually get access to your 401k plans through a first-time home purchase provision. And by the way, their definition of first-time home purchase only means that you haven't bought a house in the last 2 years.
Not necessarily your first home purchase ever.
But it is important to recognize you're going to pay income taxes on this. Pay attention to some of these rules because that could be very scary.
Absolutely. And then there are other, so that covers sort of the hardship, the unique things that the IRS chisels out. But there are other ways that you can get money out of your 401k. One is a separation of service. If you end up leaving employment, you have the ability to move the money out of your 401k. Now, we often see people really screw this up, right? We often see people leave a 401k, go to a new job, and they say, okay, great, I'm just going to cash it out. Not realizing that if you cash it out, you have to pay ordinary income taxes on that, as well as a 10% penalty if you're under 59 and a half, or if you did not leave employment after age 55. One thing that people don't realize is if you are employed with your current employer in the year that you turn 55, you can actually access those 401k dollars between 55 and 59 and a half. So that's a special withdrawal provision if you separate service after 55, but before 59 and a half.
I always think for anybody who considers themselves part of the FIRE movement, the financial independence, retire early, pay attention to these provisions, because if you are a person that's leaving the workforce at 55, definitely before 60, this is going to be your friend. We've actually worked with this on several clients where we figured out how much money would they need between 55 to 60 years of age. And we left that money back at the old employer's plan so we could pull that money out, still paid income taxes on those withdrawals, but we were avoiding those penalties because this is a great provision to give you access for an early withdrawal, early retirement.
Now, we're obviously talking about 401ks a lot in this episode. It's worth noting, though, if you are someone who has access to a 457 plan, the age limit restrictions the age limit restrictions do not apply. So, if you do have access to a 457 and you end up leaving employment, you may want to measure 2, 3, 4 times before you immediately decide to roll that into another 401k or another 403b.
Well, and that makes complete sense. If you think about the way 457s are designed, this is going to be your teachers, this is going to be your police officers, it's going to be your firefighters, and a lot of these type of careers will have early retirements before 59 and a half. It's nice that the 457 structure allows you to have access, still pay income taxes on those withdrawals, but at least you won't pay those early withdrawal penalties that a lot of the other retirement plans do have.
Now, this next one, we don't often talk about this strategy because, frankly, you just don't see it in practice a ton. But you guys have been asking for us to address this, asking for us to mention it, and it is a unique provision inside of certain types of retirement accounts, is you can do between age 55 and 59 and a half what are called substantially equal periodic payments. Yes, technically there is a way to get to your IRA assets before 59 and a half, but I would not say it's incredibly simple to do so.
Yeah, this is one of those things. I call it the great fire puzzle because, I mean, a lot of people, if you knew you were retiring at, say, 49 years of age or 50 years of age, you're like, how in the world I am retirement rich. I have 7 figures and all these employer-provided plans, these IRAs. How do I get actual access to this? Good news, the government has actually created this rule, the substantial equal periodic payments rule, where you essentially can go calculate how much money do you need to have, are you pulling out every year? Then you can go work through the government's calculations, and you can actually back into how much you should leave behind. And then what I like is if you did have a 7-figure account or a multi-7-figure account, if you calculated out that the number was going to be $600,000, you could go roll the 1.4 if it was a $2 million account somewhere else. That's right. So that money is going to be allocated and invested for the long term. And then you could keep that $600,000 that you think you would need in this example for the next 7 to 8 years. You could keep that in this essentially substantial equal periodic payment structure, so you can annuitize it and it'd be penalty free.
But no, there are some things that can run afoul. Once you start one of these programs inside of an account, you may not be able to make additions or distributions from the account, and that includes rollovers. If you violate these, there's a chance you will owe penalties and interest. So it's just very important to make sure if you're going to implement one of these strategies that you know what you're doing, so you don't run afoul of the unique rules that surround these.
Yeah, I mean, they're going to, at a minimum, have a 5-year hold. You have to do this for at least 5 years or reach 59 and a half. So this is not the type of planning decision that you should take lightly.
So another provision that you may be able to use to access retirement assets is for qualified and education expenses. Again, we get this question all the time, Brian, is if I'm saving for college or if I've got to pay for my kids' college, is this a good way to do it? Should I think about utilizing my retirement assets to do that? And there are special provisions. What you're able to do and what you should do are two very different things, though.
Yeah, this is one I always, I understand some of the hardship withdrawals we went through with medical expenses and some of those other things. But qualified tuition and education, be very careful with this because this can undercut some of your abilities. There's much better ways to save for college between 529s and so forth. So this one scares me a little bit. And plus, remember, even if you qualify for pulling money out under this education provision, still going to be subject to the income taxes and the penalties. That's not ideal.
And you may have to document if you want to use this and you want this to actually qualify for getting out of that penalty. You may have to document that you've exhausted all other college saving options. So this is really supposed to be sort of your last option to cover college expenses, not your first, or else you may be subjected to that 10% penalty for early withdrawals.